Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Ottawa and Alberta have finalized a deal on carbon pricing that will get a new oil pipeline built to the Pacific coast. Construction could start as soon as September 2027. Alberta's agreed to scheduled annual increases for carbon pricing, starting at $95 per ton this year and reaching $140 in 2040.
Today's agreement is also about creating a better world for our kids and our grandkids through major investments that will help put Canada on the path to net zero. We will also issue 75 million tons of carbon contracts for difference to support major carbon capture, clean energy, other emission reduction projects with the costs shared equally between us. In other words, we will have skin in the game so that that market actually works.
Canada's manufacturing activity continued to rebound in March. Data from StatsCan shows factory sales rose 3% versus the month before to $74 billion. The growth was softer than the agency's advanced estimate, but still marked the highest level since the beginning of 2025. StatsCan says the results were driven by a spike in energy prices fueled by the war in Iran. Shares of Magnum ice cream rallying today after a report from Reuters that private equity firms, including Blackstone, are exploring potential bids for the company. The report says the firms are monitoring Magnum's share price and waiting for summer sale before deciding on what to do. Unilever spun out a Magnum ice cream in a triple listing in Amsterdam, London, and New York in December. Here is where we are on the TSX today, down 448 points or 1.3%, sliding back under 34,000 mark we were in the earlier part of the week. Let's go stateside. Also a down day for the markets in the U.S. The S&P down over 1%. The Dow Jones down almost 1%, 462 points right now. And the Nasdaq also down today, 1.25%, 335 points on the day. So markets taking a bit of a breather. Major U.S. and Canadian indexes pulled back after hitting some record highs earlier in the week. Rising oil prices are increasing expectations of a rate hike by the Fed, as well as sending yields soaring. Let's go to Brooke Thackeray. He's research analyst at Global X and joins us now. Brooke, thanks for joining us today. Look, inflation fears are reemerging, I guess, on the market. But was there any specific trigger you saw here?
Well, I think it's been persistent around the world. We're seeing yields on government bonds increase, Japan, Germany, Canada, the U.S. So this has been happening for quite a while. And a lot of it is the price of oil moving higher. And we saw CPI move up higher, then we saw PPI move up a lot, much higher than expectations. And overall, if you look at inflation expectations from investors, they're expecting inflation to keep rising. So it's been a consistent belief that the price of oil is going to have its impact on that. And we're also seeing large government spending at the same time, which is also inflationary. So those two factors are definitely making the inflation expectations drive higher, which really puts a handcuff on the central bank governors because, you know, they from a monetary policy, they'd like to lower rates, but if inflation is rising, governments keep spending, and it becomes very difficult.
Okay. What is your feeling and how are you positioning? Are you positioning as if that Strait of Hormuz is going to be shut almost indefinitely?
Well, so, I mean, I think the market's underreacting to what's going on. It's almost like ignoring the actual situation. And, you know, as far as even if you've heard this and everybody's heard this, if the Strait of Hormuz opens tomorrow, we still have a lot of catch up and we're missing barrels and all that sort of stuff. I think there's more damage to be done here. And I just think the market hasn't woken up to this yet as far as its impact on energy, not only energy, but, you know, fertilizer as well. And that's an impact going into feeding back to inflation because that drives up food prices. So we're seeing that factor as well. So I think that don't think investors have fully priced in the Strait of Hormuz being closed for this long or longer as well. So I think that it's not priced in fully in the markets.
So if it was, what would you expect to see?
Well, if all of a sudden the pricing became start to realize what was happening, I think you'd see energy go higher. You'd see as well, I think all of a sudden there'd be a lot more concern about global slowdowns. We're seeing commodities do well because of what's happening with inflation at the same time. So I think that the commodities would continue to do well. Energy would move much higher overall as part of the commodity complex, but obviously from what's happening here. And I think it's going to come back and put a damper on the market because there's a lot of speculative investing in the market right now. We're in a bit of a melt up, and we can go through a whole bunch of metrics and talk about how overpriced the market is or whatever, but investors are just ignoring everything. So if all of a sudden we start to realize, hey, this situation could get worse or it does get worse, I think that all of a sudden a reality comes in and starts to put a damper on expectations as far as global growth goes. And that's aside from AI, the future of AI, but I think all of a sudden investors would start to fear a recession more as well and the overall slowdown. Because if you take a look at the mainstream is really suffering at this point, whether it's delinquencies or bankruptcies, or we can just go through the list, and we're seeing CEOs come out and make some comments about this, whether it's Heinz or Walmart. They're all saying the same thing. The mainstream consumer, the main consumer is really, really struggling. But not AI and not investments in AI. And so there's a very, very narrow market. So I think if things start to get priced in, and particularly inflation, I think that would actually put a damper on the market and put downward pressure on the market.
Okay, let's switch topics a little bit. Still talking about energy. What's your take on the pipeline announcement with the Alberta Premier and the Prime Minister? Was it a fair compromise deal?
Well, I mean, it's a first step in the process. It is a compromise on both sides. I guess the big question down the road is, and now that they've set up the parameters, or in the process of setting up the parameters, are they still going to be attractive for other companies to come in and expand their operations? Well, first of all, one pipeline to the West Coast. I think we'll probably get another pipeline as well. We saw Trump approve Bridger, which really is a form of the Keystone XL pipeline. So I think that's going to happen as well, those two pipelines. But I don't see a lot of pipelines. It's not like we're going to be doing what's happening in Texas, huge pipeline build out, where I don't see an Energy East pipeline coming, and that's because of all the political constraints. But overall, this is the first step in the right direction. You can't say. The big question is the deal that was done as far as the carbon goes, is that still going to be okay with companies expanding in Canada? And that's the big question.
Okay, I do want to get to something outside of energy, because you like State Street Healthcare Select, an ETF here. Why are you looking at a healthcare avenue here, which has been fairly depressed for a while?
Yeah, it has been depressed for a while, but if you take a look at what's happening here, this is the antithesis of what's taking place in the markets. If we do see this market sort of, I guess, some sort of reality, and the utility sector isn't doing well right now because the yields are rising, and the healthcare sector is more defensive from that perspective. It's not affected so much with the yields as, let's say, the utility sector. And so the healthcare sector is attractive because it's defensive in this environment. And often it can do well in what I call the shoulder season, when we move from the favorable 6-month period from October to May into May to October, the weaker 6 months. So it typically can do well this time. So it's really a safety play. It's not like the sector's going to go up and do 50% in the next year or so, something. That's not what this is about. This is about going to a more defensive posture.
All right, let's leave it there. Brooke Thackeray, appreciate you joining us on the program, sir. Have a good long weekend.
Great. Thank you very much, Sam.
As we mentioned, Canada and Alberta now have a deal on carbon pricing. We'll dig into it when we come back.
Is that we're close to making Canada a global energy superpower at a time when energy security has become a top priority around the world.
So that was the Alberta Premier, Danielle Smith, after announcing with the Prime Minister that Canada and Alberta have now reached a deal about carbon pricing that will also pave the way for construction of a new oil pipeline. Let's go to Bloomberg's Calgary Bureau Chief, Ian Bokoff. He joins us now to talk some more about this. Ian, there's an agreement here on carbon pricing, but can you explain what the price has been so far in Alberta and what actually changes?
So this year, the carbon price is frozen at $95 per metric ton, and the target is to get to 140 by 2040. That's much lower than what the Trudeau government set out at $170. And this agreement also addresses the carbon market, which the effective trading price of carbon right now is about $40, so much lower than the $95 that it's supposed to be. And so this agreement will looks to correct that and kind of introduce a price floor for the coming years and a target of getting up to that $140 per metric ton by 2040.
Okay, let's talk about another key part of this deal was supposed to be carbon capture. The reductions target outlined is much lower than what was expected. What does it mean for the industry?
So the industry, under this agreement, basically they get to kick ahead their capital expenditure, and it's also much lower. So the original Pathways project was targeting about 22 million tons annually in greenhouse gas reduction, and this agreement only does about 16 million by 2040. So it significantly lowers the scale of the project, and it also puts it off a few more years. So in the short term, the industry can focus on growing production in order to fill a new pipeline.
Okay, and let's get to, of course, the pipeline. What are the new details announced today for that?
So the pipeline did have some new details. The Alberta government again said they committed to a July 1st target, on or before July 1st, to get a proposal into the Major Projects Office. And then the federal government is agreeing to, by October 1st, designate this project in the national interest, which would then speed the regulatory process. And they also set out a September 1st date next year to have all the approvals done and potentially for construction to start. So it would be a very speedy timeline and one of the fastest regulatory approvals for a pipeline that we've seen.
Okay, I do want to get to the separatist movement in Alberta that we've been talking about. We know there's a push and some people are much unhappier with the slow progress that has been made on energy projects so far. Do you think what was announced today will change any of that sentiment?
So the Premier actually addressed this in her press conference after the announcement. She said, the federal government has made a lot of steps here, a lot of concessions to Alberta and to the industry to speed along projects and to lower the burden on Alberta and the industry. And so she said she felt that this was a good deal for Alberta and showed that federalism was working, that Ottawa could be a good partner along with Edmonton. And so she hopes that this is addressing some of that sentiment, which has fallen, as she noted, has fallen a little bit in recent years after the Trudeau government. But I mean, the separatist movement is still very strong, and they say, one pipeline doesn't change much for them. But we'll have to see in the coming weeks what this might change.
Bloomberg's Calgary Bureau Chief is Ian Bokoff. Thanks for joining us today. We will continue our coverage of the new carbon pricing agreement between Alberta and Ottawa when we come back. We filled you in on that announcement by the Prime Minister and Alberta's Premier. Let's work through the details with Heather Exner-Perot of the Macdonald-Laurier Institute. Heather, thanks for joining us today.
Yeah, happy to be here.
All right, so we have very contentious issues that have a lot of history to them. Sometimes it's best when at the end no one is entirely happy. Does this agreement sort of fall under that banner?
I really think it does. These are difficult things. Obviously, the Liberals base and the UCP base, have some different values on this. And so to find a middle ground, I think was pretty good. I think both sides, went, compromised. Of course, industry is the third wheeled here. And at the end of the day, all this is about how fast industry can produce. And some industry is happy. You saw electricity, natural gas, Termline at the press conference, and still, kind of mum from the big heavy oil producers.
Yeah. The Prime Minister wanted firm carbon pricing and a commitment in there, but it's lower and slower. So effective price target at $130 a ton by 2040. Did Alberta get the edge here?
I think they did. People forget that Alberta has actually had a industrial carbon price since 2007. So there might be a feeling that this is newly being imposed. No, Alberta has a system. A lot of people have made investments based on the system, and they've got a bit more control over, how fast that goes up. And there's a big difference between that headline price and actually the price of tier credits that are traded in the market. There was also some information on that. There'll be a floor price, but not until 2030, and starting at about $60. So that all seems, relatively reasonable. Again, if you're a heavy oil producer, you're feeling the brunt of that. There's maybe the other ways to compensate them with competitiveness. But overall, this feels to me like a pretty good middle ground.
Okay. Can you explain how that difference works? We talk about the effective price versus the headline price.
Yeah, so it's not like the consumer carbon price where it's just a price and you paid it at the gas pump and saw it on your utility bills. The producers and emitters can buy carbon credits and they can sell them and trade them. And they do. And that price has usually been around, $40. It's been as low as $20. That had environmentalists upset because at $20, you weren't incentivizing a lot of emissions reduction. So what this says is that the credits must be traded at $60 and going up until 2040, but starting in 2030, you have that floor price. And so it's not that sticker shock, I guess, of $130 that people are thinking of. It goes up a bit slower than that. And again, if you can be a relatively good producer, that you're above the benchmark, you pay even less than that.
Let's talk about carbon capture, because they gave a few details, but not a lot. And it looks like the emissions or the amount of carbon they want to capture now is a lot lower than originally anticipated. Do you think this is perhaps the thorniest issue behind the scenes?
Well, it does seem thorny behind the scenes, but I think the resolution is quite good, for Alberta, for producers. That, it's been leaked into the media the last few days about the dates, and, Alberta will submit and the government will designate it by October and it'll be approved by September. And even today, there was under the technical briefing, Alberta said they expect that Northwest Coast Oil Pipeline to be in service by 2033, 2034. The MOU, the agreement, says that Pathways, the first phase, will not start until 2035. And so if you're an investor, I think that's 9 years out. A lot can happen between now and then. Obviously, sequencing, you can't build and fill a new pipeline and also build that Pathways Alliance project. That's too much labor. It's too much contractors. And so I think this does set the stage for no immediate investor risk whatsoever, and being able to pace yourselves out the next 10 years to see how that goes.
Okay. Are you concerned? There's a lot of talk about whether there will be private backing for the pipeline, if any interest has been shown. We know that there has been a problem in the past with private investors worried about the regulatory concerns, worried about the timeline. Do you worry at all about private backers coming up for the pipeline later in the process?
I don't. We have a lot of pipeline egress that has been announced with the Enbridge Mainline expansion, the Trans Mountain expansion, and looking likely the South Bow Bridger pipeline. And so the private sector focus will be on those, as it should. Alberta will carry on, and I think gets this to a point where it's approved. And that would probably be a point where it's sufficiently de-risked that a private proponent might then be interested in it. So for me, in these next 1 or 2 years, I don't feel there's a sense of urgency to bring a private proponent on. Alberta can do the work to get it to that point. Oil sands producers, as you know, have said this process is just slow. It feels like people are dragging their feet. Will the announcement today, you think, be enough to satisfy them? So, nothing's perfect, and none of our competitors are perfect either, by the way. But this is so much better than what it was a year and a half ago. And I'll take the CEO of TC Energy saying last week, good is not good enough. I get that. but this is such an improvement. We're coming into a commodities upswing. There's a high demand for Canadian energy, and things are a lot better. And we still have, the icing on the cake, which is the regulatory reform coming up, which will probably be passed by the end of June. And so in combination, those things, the certainty we got today on industrial carbon price framework, I think people at least can model it, can make some decisions, can go ahead with some things, and start building. I think we're done with the headlines, and it's time for the pipelines.
Got it. Heather Exner-Pirot of the MacDonald-Laurier Institute. Thanks for your time. Appreciate it.
Thanks for having me.
Honda's decision to park its billion-dollar plan to build an electric vehicle complex in Ontario comes at a time when there's new EV sales excitement. March saw an increase of almost 75% from a year ago compared to gas-powered car sales, which are down. CTV's Adrian Gabriel reports.
An acceleration in electric vehicle sales is driving a surging trend across the country. This new Statistics Canada report has revealed that in March, there were more than 21,000 new zero-emission vehicle sales in Canada, a spike of more than 74% year over year.
They are in high demand. So is there a future for electrified vehicles? I mean, there's a present and a future for electrified vehicles.
And it's all Canadian.
In February, the federal government announced a new 5-year EV incentives program, offering rebates of up to $5,000. Automotive insiders believe it's in part a driving factor.
The surge of gas prices and the return of the federal EV incentives is helping to drive those sales.
Another variable being cited, Canadian consumers becoming more familiar and open to the idea of going green.
We have consumers who have experience, their neighbors have experience with EVs, and they're trusting them.
New EV sales made up more than 12% of all vehicles sold in March, up from just over 6% during the same month last year. While Honda has indefinitely suspended its $15 billion electric vehicle complex in Ontario. In St. Thomas, Ontario, construction of a massive EV gigafactory battery plant is well underway, with production set for next year. Ottawa has also opened the door for 49,000 Chinese-built electric vehicles to enter the Canadian market. Demand from budget-conscious consumers is expected to be strong.
We're also hearing about exciting hybrids in the pipeline, and the variety of consumer choice is going to be building from all over the world.
One roadblock impeding EV growth, according to those watching the trends, is consumer anxiety over accessibility to functioning charging stations in communities across the country. Adrian Gabriel, CTV News, Toronto.
Let's have a quick look at the markets before the end of the trading day and the end of the trading week. North American markets in the red. The TSX down over 1%, 1.4%, 462 points down. The S&P had a high yesterday, a closing high yesterday. It's down today 1.26%, so 94 points. And then the Nasdaq also retreating from a high yesterday. 410 is where it moved down 1.5%. We're back with the closing end of day numbers in just a moment. Stay tuned. Here are the closing bells, for the end of the trading day as well as the end of the trading week at the TSX 121 Mining Investment London ending the day. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. It was a down day for the North American markets. As you can see, the TSX Composite losing 1.3%. That's a 434-point drop on the day, and it did slip back under the 34,000 mark. The S&P is down 92 points, or 1.2% today. And then the Nasdaq also down, 410-point move, down 1.5% down today on concerns about inflation. Let's go to the TSX and see exactly what stocks have moved. Bird Construction is where we start. It's actually a gainer. Look at that, 14% up, or $7.26 to $58.35. They got news that BCE is going to select or use them to build a data center. We're going to have details on that with Jeff Morgan in just a moment. Moving on to Strathcona Resources, an energy play here. It moved up almost 7%, or $3.14 to $48.49. Stantec is an engineering and architecture firm. It is up today 6.5%, or $6.48, even though their price target was lowered by TD Securities and Scotiabank. In the red today, we're going to start with Curaleaf, down 13%, or 71 cents to $4.69. And a lot of metals on the move today, losing, including America's Gold and Silver, which dropped 8.7%. Wesdome Gold, which is also down more than 11%. So some movers there. Let's go to Bloomberg's Jeff Morgan. He joins us now with a deeper look at what happened on the markets. Jeff, let's start with Bird Construction and that contract for Bell. Tell us a bit more about it.
Yeah, the contract for Bell, this stock has started moving up first on Thursday as a result of this. This is a 300 megawatt AI data center that Bell is planning to build in Saskatchewan. Newly IPO'd Cerebras as well as CoreWeave are going to be customers on it. And this was such a bit of positive news for Bird Construction that it's actually led now to a handful of analysts raising their price targets, including at Stifel. Stifel raised the price target on Bird Construction today up to $64 Canadian a share from 55. So a pretty hefty price target lift from the Bay Street community. Looks like looks like Bay Street analysts are pretty bullish on the kind of the outlook here as a result of this data center build. Bird is one of those companies that had been expected to kind of participate in this overall push to build more major projects in Canada. This is an additional one, and certainly the outlook here is supportive for Bird now. So we've now seen another day of pretty strong gains for Bird, top performing stock in the S&P TSX Composite today.
Okay, let's get to America's Gold and Silver. They had their Q1 earnings that they shared. What did we learn?
Yeah, they had their Q1 earnings. Silver production a little bit ahead of expectations, but otherwise, this is kind of a stock that is unfortunately reporting earnings that were maybe a little bit ho-hum on a day when gold and silver stocks are just having a rough ride in the first place. So if you look at the bottom performing stocks on the TSX Composite today, it is populated and dominated by the gold and silver names kind of in general. And this is certainly one of them. So what's happened here? Gold is one of those assets and silver is also one of those assets that competes for space in investor portfolios against bonds, and bond rates and bond yields have been rising pretty significantly in the US, which is really weighing on the gold and silver price. So today we have had a drop in gold and silver commodity prices, and that is weighing on the TSX as well, because there's such a heavy weighting of those precious metals names on the TSX now. Okay, we will leave it there. Jeff Morgan, thanks for joining us. Have a good long weekend. Let's get to mover south of the border. Bloomberg's Avalon Purnell joins us now. Avalon, the U.S. president had a couple of days in China. Did any stocks gain on that meeting between the leader of China and the American president?
Absolutely. NVIDIA and Boeing were both in focus after that meeting. NVIDIA fell about 4.4% into the close today. That's after there was no headway made on their chips deal. President Trump said that China hasn't approved purchases of NVIDIA's H200 chips, partially because they want to develop their own. In fact, he also said that Trump actually said that NVIDIA's chip sale didn't even come up during his China summit. But that wasn't the only thing that disappointed investors. Boeing also dropping 3.8% into the close. That's after receiving a smaller than expected order for jets. Trump said that China would buy around 200 aircraft, though he later suggested that they may even purchase up to 750. But again, the details remain quite murky. And what I found interesting was that analysts did say that while China is a large market, potentially it may not be as important as one may think for Boeing anymore, especially given the trade and geopolitical tensions that seem to be continuing.
Okay, let's get to Dexcom. They're a medical devices company and one of the top gainers today. What's behind that?
Yes, Dexcom jumped 6.6% into the close for its biggest one-day leap since February. That's partially because activist investor Elliott Investment Management took a stake in the diabetes firm and struck a deal to name up to 2 independent directors to the board. Separately, Dexcom also offered a rosy long-term growth outlook at its investor day. Worth noting that we actually had Dexcom CEO on BTV here in the US earlier this morning and said that customers taking GLP-1s like Ozempic have actually higher utilization of their devices, those CGMs, than those who don't take those drugs. Investors have been really concerned about how exactly the GLP-1s will impact those diabetics who are taking these devices and using them to keep track of their blood sugar, but this all kind of helped them become one of the top gainers on the S&P 500 today.
All right, Bloomberg's Avalon Purnell with that update. Thank you. Appreciate it. Up next, U.S. markets cooling, as you saw, after reaching new highs earlier in the week. We'll look into what else is driving the pullback when we come back. The markets have been looking past the oil crisis off and on for months, some say, but inflation concerns definitely took control today. Let's go to Peter Barras, and he's Chief Global Investment Strategist, Director of Research, BCA Research. Thanks for joining us today.
Thank you.
What do you think is reigniting the inflation concerns today?
Well, it's the risk that the crisis in the Middle East continues to simmer. If you look at December 2026 oil futures, they've increased by around $10 a barrel over the last month, implying that investors are increasingly concerned that the Strait of Hormuz will remain blocked for at least the next few months.
Do you think that perhaps investors were hoping there would be some sort of resolution with China, perhaps a commitment from China to sort of intervene in this?
I think there was some hope of that, and it didn't materialize. China seemed more interested in discussing Taiwan at the summit. And Donald Trump, of course, he wants the strait to open up, but I think he's getting also frustrated with the whole situation, would rather be talking about something else. So right now, it doesn't look as though the strait will open up anytime soon.
Should the market, do you think, have been looking past this, considering how long this has gone on? I guess perhaps the excitement over earnings in tech was a good distraction.
Yeah, I mean, historically, oil shocks have had a lagged effect on the economy, which means that often they've also had a lagged effect on the stock market. I think investors sort of took some comfort in the feeling that both sides have an incentive to reach a deal, but Iran doesn't seem all that willing to strike a deal right now. And while they cannot win a military conflict with the U.S., they can still keep the strait closed. Look at the Houthis in the Red Sea. You know, that waterway has been effectively closed for close to 3 years now. So that's the risk for the Strait of Hormuz.
Historically, how long is the lag? When would the expected hit come?
As a rule of thumb, it takes about 4 quarters for an oil shock to have the maximum impact on the growth rate of GDP, and close to 6 quarters for it to have the maximum impact on the level of GDP, which means that we might not see the full effect of the oil shock until the end of this year, perhaps even early next year. That's the risk, that this shock doesn't go away and continues to haunt the economy and financial markets. Right now, inventories are being used as a buffer. Oil production is down 12%. Inventories are falling, and so demand hasn't fallen nearly as much. But there's a level at which inventories can't fall any further, and unfortunately, we're getting closer and closer to that level.
And you don't expect any deal that does get made on the street to actually last?
Well, I think there's a high risk that it doesn't last. I think realistically, Iran would like to do what it can to undermine the electoral prospects for the Republicans in November. And so if they can keep gas prices high, that hurts Republican odds at the poll, which is something that I think the Iranians would welcome. So politically, they have an incentive to continue to stonewall. I would also say that there's probably a power vacuum in Iran at the moment. And in a power vacuum, the meanest, toughest guy usually rises to the top. You don't sound mean and tough by saying you're going to negotiate with the U.S. And that's sort of creating this Darwinian effect that's making the Iranian leadership move in a hardline direction.
So earnings, as we spoke about, have been pretty strong, especially for tech. But generally speaking, are you revising any expectations for the next quarter? You mentioned the lag might not hit fully for another year, but because of the energy prices, are you taking into account some hits next quarter?
Not next quarter, but certainly towards the end of this year, if the issue in the Middle East doesn't improve, we're going to have to start really knocking down those earnings estimates. As you said, the estimates have been rising, and they've continued to rise right through this whole crisis. But the reason they're rising is because of the AI trade. It has nothing to do with relief over oil. And those estimates are vulnerable because what's happening is effectively now in the tech space is that companies are making a lot of money by selling memory and semiconductors. Those companies that are selling these products are booking big profits. Those companies that are buying those products, they're just treating that as capital spending. It doesn't affect their reported earnings, and that's causing earnings to go up even as cash flow doesn't rise.
So where are you putting money these days? What are you investing in? Some of these stocks, as you mentioned, energy stocks, tech stocks have really moved up. So would you put new money in there? What are you looking at?
Well, I think energy stocks still trade fairly cheaply relative to their long-term prospects. They haven't moved up as much as one might have suspected, partly because investors do think that oil prices are going to come back down towards the end of this year. But realistically, that might not happen. And also, governments are going to be much more keen to build up reserves. That's going to place some demand for oil. So I see energy stocks as being a good hedge against continued geopolitical tensions in the Middle East.
Peter Barrison, I'm going to leave it there, but I appreciate your time. Peter's Chief Global Investment Strategist, Director of Research, BCA Research. Up next, we turn our focus more on China, taking a closer look at how China was able to capture the rare earth market. Back in a moment. Rare earths are the backbone of modern tech, and China has cornered the global market on them. It uses that dominance for leverage, but can other countries break the grip? The weekly doc from Bloomberg dives deeper.
It doesn't look like much, but this is the prize for the rest of the world in trying to catch up with China.
We need rare earths.
China owns them, processes them, refines them, and sells them. The entire supply chain is built around Beijing.
No matter what you do, you're always kind of beholden to China.
Rare earths are really the backbone of modern technology.
China's the ballgame. They're 80 to 90% of production and processing of rare earths that go into all equipment around the world.
And China's shown it will use that dominance as geopolitical leverage.
The main use of rare earths are in these powerful, high-performance magnets.
China's capacity for magnets is vast compared to the rest of the world.
When Donald Trump returned to the White House in 2025 and rebooted the US-China trade war, China responded with export controls on rare earths that expose just how much Western manufacturing still depends on China's supply.
The automotive industry came out and not so quietly said, we are going to have to shut down factories if we cannot get these permanent magnets.
That shock set off a broader scramble to build a new supply chain from mine to magnet.
This is a story about not letting one country hold all the chips on what is a very important supply chain.
The US-China trade war has begun.
In case you'd forgotten how influential rare earths are, it was little more than a year ago that they forced a pause in the US-China trade war.
We have a 145% tariff on Chinese goods. Neither one wants to be the one to pick up the phone first.
In April 2025, US President Donald Trump slapped huge tariffs on Chinese imports. Beijing fought back, pulling out its rare earth bazooka.
The automotive CEOs from Detroit were all showing up telling Donald Trump, if you do not get those permanent magnets, which are made from the rare earths, moving back into the United States, we're going to have to start shutting factories.
Beijing had located the weak spot, and at the center of it was a group of metals most people never think about.
Rare earths are a group of 17 metallic elements that are chemically very similar.
They can seem obscure, but the important thing is what they do. They help create powerful, heat-resistant magnets.
They're used in most of our modern technologies, especially in electric motors. They make our gadgets smaller, lighter, and more powerful.
From phones and wind turbines to electric vehicles and missile systems, rare earth magnets sit inside much of modern technology. And that means the global high-tech economy relies on one country.
China is home to the world's largest rare earth deposit that's been discovered so far. And specifically, it has deposits of heavy rare earths, whereas the US has very, very little.
Heavy rare earths are the most expensive and sought after. They allow high-performance magnets to resist heat and demagnetization.
The real choke point is the processing stage. China controls 90% of the refining process. And then it goes to magnet production, which is the process of making rare earth metals into magnets. And China controls about 90% of that as well.
Mining the ore is only the start. The real work is in the chemistry, separating and refining each element into something magnet makers can use.
The production is so costly and also environmentally very damaging because the processing stage, produces a lot of toxic waste, including radioactive materials. So a lot of Western countries, they're happy to let China take over.
And you can see why. This is Baotou in Inner Mongolia, home to China's largest rare earth production site.
Wherever you are in the world, at some level of that supply chain, you are probably reliant on Chinese products.
With China holding such a dominant position, why did it come as such a shock to the Trump administration when they chose to use it?
Really shouldn't have been because China used the exact leverage 15 years ago.
Perhaps because last time it wasn't the US in the crosshairs, it was Japan.
China first used its dominance over rare earths as a geopolitical weapon in 2010 when they restricted exports to Japan because of a territorial dispute.
China said, okay, we are going to restrict the exports of our rare earths that you need, Japan, to turn into the permanent magnets that go into your automotive industry and other industries. This was the first kind of shock to the market.
It lasted only weeks. Even so, it exposed Japan's vulnerability and offered an early warning of how much leverage China had built. To understand how that happened, we have to rewind.
Actually, the US was the biggest player in rare earth all the way from the 1950s to the 1980s. China is a latecomer in the industry, but it caught up really fast.
This was not an accident. Beijing treated rare earths as a strategic industry and built capacity all the way down the chain.
China's late paramount leader Deng Xiaoping has said famously that the Middle East has its oil, but China has its rare earths.
As China scaled up, it became cheaper to buy from there than to make it anywhere else. In the West, thin margins, high labor costs, and dirty processing pushed many operators out.
Consumers were happy with the status quo because they got a steady flow of cheap, reliable supplies of magnets from China for many, many years.
But now the risks of relying so much on China are clear, forcing countries to make their own rare earth plays. This is the largest rare earth processing site outside of China. It's run by the Australian mining company Lynas, which has a $96 million contract to supply heavy rare earths to the US Department of Defense.
Lynas is really the leader in the wave of companies now trying to rebuild the rare earth supply chain outside of China. They started more than a decade ago, took them a long time to start ramping up production.
Lynas aims to produce over 10,000 tons of rare earths oxides per year from this site. But most importantly, it's worked out how to produce heavy rare earths.
We broke the monopoly on separated heavy rare earths last year in May 2025. We are the only producer at scale of both separated lights and separated heavies outside of China.
Rebuilding a supply chain this specialized also means rebuilding skills, experience, and industrial muscle.
Last year in the US, they graduated 35,000 lawyers. They graduated 350 mining engineers.
Meanwhile, China has a dedicated mining and engineering university with 25,000 undergraduate students.
China has invested in developing competence in the rare earths market and getting better and being more efficient every day.
And the urgency for the US has only grown as its war with Iran has depleted the Pentagon's advanced weapon stocks.
We've seen the US burning through its stockpiles of defense systems and weapon systems really quickly. And the US will need to replenish these stockpiles. And to make weapons and defense systems, it requires rare earth.
The US military's exact demand is classified. But a recent report by the Center for Strategic and International Studies estimates during the Iran war, the US has used more than half of its pre-war inventory of some very expensive munitions.
There is definitely a sense of urgency, and it's not just the United States. It is the Western world.
If countries want an alternative to China, they need more than new factories. They also need new deposits. And Brazil is one of the main bets. Latin America's biggest economy is home to roughly a quarter of the world's rare earths, according to the US Geological Survey. This site in southeastern Brazil is run by another Australian developer, Meteoric Resources, that's also receiving backing from the US. The company says there are 1.5 billion tons of rare earth clay in these hills.
Our main objective right now is to put the project in production, to be the next to the world, to produce the mixed rare earth carbonates, and to develop the technology to do the separation. And we can do that differently as China does right now. If you want to be sustainable, you have to buy from a sustainable market.
And the US is also investing at home. Their biggest hope is the Pentagon-backed MP Materials. The Department of Defense bought a $400 million stake in the company in 2025. It expects to be able to separate heavy rare earths later this year. But the problem for every would-be challenger, China's big enough to squeeze margins long before new competitors are secure.
The Western world are intervening and saying that they're willing to put up money to build out these companies, to effectively be a partner that says, we're going to backstop any chance that China takes to flush you out of the market.
China's restrictions on rare earth exports to the US have been relaxing, but its ban on exports for use in US weapons is a red line.
目的是防止稀土非法外流，非法流向大规模杀伤性武器等不当用途。
I think the main lesson we can draw is that building up the supply chain takes time and a lot of efforts. Japan's dependence on China only reduced from 90% in 2010 to about 60 to 70% now. So you can tell that the 15-year process is long and it's slow.
If you're a company that wants 60% from China or 40% from the rest of the world or 50-50, that's a more realizable goal up to 2030 and into the early next decade.
A Bloomberg intelligence report estimates $10 billion of public funds will be invested in rare earth ventures outside of China in 2026. That's a big turnaround.
The monopoly is not going to be broken within the next 5 years. But the US, Australia, Brazil, Japan, South Korea, France will all begin producing some commercial scale of permanent magnets of rare earths. And if you're sitting here 5 years from now and those nations are all producing stuff that actually goes out the door to major buyers, then that's a win.
Coming up next, what came of that high-profile red carpet visit by the U.S. president to China? Back in a moment. No key deliverables on the key issues from that meeting between the U.S. president and the Chinese leader. Let's go to Matt Gertkin on this, Chief Geopolitical U.S. Political Strategist, BCA Research. Thanks for joining us.
Thank you.
So if we take Iran and Taiwan as the top issues of the day, did you see any clear commitment on either?
No, there was no commitment. China is not going to intervene in the situation in Iran. The U.S. is already blockading Iran. And so China's leverage over Iran is their oil imports, but those are already being interrupted. So this is really, from China's point of view, a demand that the U.S. remove the blockade and agree with Iran to then restart shipping that way. And the U.S. is still holding out to try to get a deal on the nuclear program. So China's sort of a bystander and not getting what it wants, and the U.S. didn't get much from China either.
Okay, so let's talk about the weapon shipment that is on hold in the U.S. that is meant to go to Taiwan. Do you think Donald Trump can actually block it at home?
Yeah, well, I mean, presidents always delay arms sales to Taiwan until it's politically convenient. They'll often wait until after an election in a lame duck session. You know, the perfect time for the president to do this is a major arms deal. I mean, in fact, it could be a $24 billion combined arms package when it's all said and done. And the best time for President Trump to do that would be in December of 2028 after the U.S. election, because he's already on the way out and the next president could claim to have no involvement. And that might then give the U.S. some plausible deniability. But basically, the president did not indicate that he's going to hold up Taiwan arms, and he certainly did not abandon the strategic ambiguity that the U.S. has always had about whether it would defend Taiwan.
Let's talk about Iran a little bit more, if you don't mind. Oil prices increased today. Do you think that perhaps investors in markets thought perhaps China would intervene in some way, or at least agree to talk to Tehran?
Yes, I think that the market believed that China would intervene in a more muscular fashion, exerting overall pressure politically on Iran. But that is a misreading of Chinese policy and strategic partnership with Iran over decades. The real issue here is that the U.S. Had a set of talks with Iran that were taking place in Islamabad, Pakistan, and China may have been influential in making Pakistan the interlocutor and the intermediary there. But the issue is that those talks have not progressed, and Iran is still basically banking on the fact that the president is worried about his midterm election, and therefore they can hold out longer, they can impede shipping longer, and as long as there's a ceasefire, they're not getting attacked, so they can sort of cause agitation and trouble in the oil market, and they don't have to give up their nuclear program. And so I think that's why the oil price moved up. And we also had a couple of attacks on shipping.
I'm just wondering if China's getting some of their shipments through, and perhaps that's why they're not as worried about the Strait reopening the way other countries are.
Well, they might be able to get 200,000 or 300,000 barrels per day of oil through rail. And then the blockade itself has not been watertight. And there probably is a reluctance on the American side to aggressively enforce the blockade when it comes to Chinese oil, because that's provocative and could be perceived, or arguably would be seen as, an act of war. So the U.S. doesn't want to embargo China or blockade China. But what it does want to do is crank up the pressure on Iran. And apparently it hasn't been enough, because the Iranians are not yet giving President Trump what he wants to hear on the highly enriched uranium stockpiles that have not been turned over.
So let's talk about the big tech executives who were on that trip to China. What was the point of that, do you see? We didn't really have any tech announcements come as a result of that.
Well, I mean, we don't know fully yet. I mean, there could be some things coming from it. Obviously, the president has slightly eased the export controls on chips that NVIDIA produces that are useful for artificial intelligence. And Elon Musk, Tesla wants more market share. They've been losing market share in China. Apple has been losing market share, would like to retain their smartphone market share. So this is an issue where President Trump signaled he wants to focus on Chinese market access, which, of course, is always the dream in dealing with China for all countries. But the president is also signaling that he's hearing these corporate and these tech leaders when they say that if the U.S. prevents China from buying these advanced tech goods, then American companies will be squeezed out and China will be forced to invent indigenous alternatives. And then the U.S. will lose that market share, but China will advance anyway. And so we see that the president is actually sort of modifying the tech war, at least for the time being. But over the long run, it's still going to be an extremely tight export control regime, I'm afraid.
Matt, what about tariffs, which were really Last year, the thing everybody was upset about, up in arms about, China was really upset. Now they kind of seem to have taken a backseat, and I'm wondering whether you see any movement coming on the tariffs in the near future, or whether now those are a thing of the past and people are going to leave them alone.
Well, yeah, tariffs are a joke compared to the closure of the Strait of Hormuz, first of all. But second of all, President Trump was forced to backpedal last year because he almost induced a bear market, which would then likely have induced a recession. And so he modified his tariff approach and then came together the trade truce in Geneva with China. And that was what was upheld in October and then just now in Beijing. And so what we're seeing is a trade truce because the president didn't want to go forward with the full weight of these tariffs that would have disrupted global trade. And of course, China has been, U.S. Imports of rare earth elements from China and refined rare earths from China, those are shrinking at double digits right now still. So China had a weapon to hit the U.S. back. And then finally, the Supreme Court and U.S. institutions came into play, as they were always going to, and they effectively showed that the president does have some limitations in how he uses tariffs. So the bottom line is that the tariff, they will come back probably after the midterm, but the president's one area where he can still wield significant tariff authority is China because of property, intellectual property theft, and national security issues. And so when tariffs do come back, maybe next year, China might actually be a bigger target than it was previously, and other countries might get off the hook a little bit.
Matt Gertken, got to leave it there, sir. Thank you for joining us. Appreciate it.
Thank you.
All right, coming up next, the Alberta Premier Danielle Smith sat down with our colleagues at Bloomberg TV to talk about the new pipeline plan and carbon pricing. We're back with that conversation in just a moment. The Prime Minister, Mark Carney, and the Alberta Premier Danielle Smith announced today an agreement on carbon pricing and plans for a new pipeline. Premier Smith sat down with our Bloomberg colleague, Katie Greenfield. Here's that conversation.
What has happened out of the Strait of Hormuz disruption is that a lot of the Asian markets have realized they need to diversify where they get their energy from. And I have even talked to one ambassador who said, the Strait of Hormuz could be closed once. It could be closed again. And so that's part of the reason why they're looking to develop new relationships with new suppliers, and why I think it's more important than ever that we build a second pipeline off the west coast of Canada. We already have Trans Mountain Pipeline, which is serving some of those Asian markets, but we think essentially that they will take whatever amount of energy we're able to provide to them, and it will act as a hedge against that insecurity of what might happen in the Middle East.
And so let's talk a little bit about how this pipeline gets built, because your government is doing the initial planning here, but you've said that this should be built by the private sector. And I wonder, what that looks like, how confident you are that you can get energy companies or that you can get private equity to sort of step up here and sign on for a project that is estimated to be pretty large.
Well, I think it'll be three parts. So one part is going to be Indigenous ownership. As you know, we've developed a relationship with our Indigenous peoples where we underwrite loan guarantees for major infrastructure investments, and Canada has done the same. So we both have the ability to allow for the nations along the route to take an equity stake. So that's where I think that both the provincial and federal government will have a stake. Then of course, you will have a pipeline company like you just spoke with Greg Abel. I saw either he or Trans Mountain Pipeline or South Bow or another proponent would also take a stake. And then we also suspect that there'll be some interest in the buyers themselves. We've seen this model with LNG Canada, where it was a consortium of Asian buyers who essentially provided the capital in order to build that project because they're going to be the ultimate recipients. So that's what we would be anticipating. It would be some combination of those, but it had to begin with a sense of certainty that it could be built. We had an unfortunate situation with the Keystone XL pipeline where the presidential permit got canceled. That cost our government $1.5 billion, but it also cost the industry. We've had other projects that went $1 billion into the regulatory process and ended up pulling the plug because of no chance of getting approval. So having the guarantee that you've got the provincial and federal government working together and we're committed to making this work, we think that there'll be several different private interests that will ultimately line up to build it.
Well, to that point, I do want to talk a little bit about how the oil producers in your country feel about this, because, you know, we've heard a lot from the industry when it comes to carbon pricing. And as I understand it, Canada is really the only major oil producing nation that has a tax like this. So, I mean, what have your conversations with those companies sounded like, and especially now that there is a plan to increase the tax that they pay?
Yeah, well, I would say that we've had this kind of carbon pricing on large emitters in Alberta since 2007. It's those who emit over 100,000 megatons a year. So it's actually quite narrow on the very large major producers who would be paying it. The question we always had is how much would it cost to comply? If under the old regime it was going up to $170 by 2030, we've managed to negotiate with the federal government a slower rise to 130 by 2035, which we calculate will save the industry about $250 billion worth of compliance costs over the lifetime of this agreement from the status quo. That's a lot of money freed up to be able to invest in technologies, to be able to invest in expanding their production. And so we're going to continue talking with the producers. That's sort of the next phase of this negotiation as we work out the carbon capture, utilization, and storage project that the Pathways group of companies, the oil sands group, has proposed. But we think that this is certainly a sea change improvement over where we were before this was signed.
Well, Premier Smith, let's talk a little bit about timelines. And I want to start with the first deadline, and that is July 1st here when you submit the pipeline proposal. How confident are you that you're going to have a private sector proponent in place when you do submit that?
I would say that we have to be clear about what the pipeline route would be, and we've been working with 3 pipeline companies to understand the economics of that, the engineering behind that. So all of our major pipeline companies are at the table giving us advice, and then when we have it approved on the major projects list, which the government has given us an undertaking for conditional approval October the 1st, and then the work begins, of course, with the consultation with the Indigenous groups and working out in some of the environmental accommodations that will need to be made along the route, with the idea that by September 2027, we'd be ready for shovels in the ground. Now, we will continue to walk with the companies all the way through to that final investment or to that ultimate approval. But I would anticipate at some point, by the time it's approved in September 2027, we'll have a pretty clear idea of who the various partners will be who will build it on our behalf.
Well, that's the second part I wanted to introduce, September 2027, you know, when you might actually start the construction of this new pipeline. I mean, how confident are you around that date, or is that something that you would expect to maybe shift around a little bit here?
Well, we have to move quickly. I mean, I've watched with great appreciation as the U.S. administration has issued several presidential permits for multiple pipelines going south. You just spoke with Enbridge. They have many permit approvals that will allow for them to do continued expansion, including of their mainline 400,000 barrels. South Bow and Bridger are partnered on a project that also received presidential permit approvals. And so we're looking with great interest at the speed with which the American administration has been able to move, and realize that we have a particular advantage in being able to get pipeline to the West Coast and feed that Asian market. We're about 8 to 10 days away from some of those Asian markets. We already have established with TMX that there is a thirst and a demand for it. And so that's part of the reason why we think we have to move quickly. I think with the disruption in the Strait of Hormuz, the urgency has really elevated with all of those potential buyers.
And Premier Smith, I only have about a minute left with you before a hard break, but I want to talk a little bit about the separatist movement in your province, because there's a group that does want independence. They've submitted a petition looking for a referendum. This week, a court blocked it. You were unhappy with that decision, and I wonder if the courts do continue to block this petition, will your government step in and put this question to your voters?
Well, I'm worried about the court blocking all citizens' actions. I look at it more broadly, that we want to be permissive to allow people to put forward issues that are angering them so that we can have a good open debate on them. So I do feel that the court overreached, which is why we want to preserve the legislation and preserve that pathway. But for my part, I support remaining in Canada. I support Alberta autonomy within Canada and a cooperative federalism. And that's a demonstration of what you saw today, is that when we have disagreement, we come together, we sign an agreement, and we do something that's good for us as well as for the entire country.
The Alberta Premier Danielle Smith in conversation with our colleagues at Bloomberg. Coming up, hot picks. We will zero in on 3 pharma stocks for your portfolio when we come back. Time now for some hot picks, and we zeroed in on 3 plays in the pharmaceutical sector. For more, we're joined by Evan Seekerman, Managing Director, Head of Healthcare Research at BMO.
We just finished first quarter earnings, and actually they were pretty good prints across the board. I think sentiment ending last year was good. Beginning of the year, a little kind of wishy-washy, especially with some of the macro concerns. But leaving 1Q earnings, people are feeling good about the sector. Yes, there are still some, areas where some of these pharma companies need to work on, but I think there's renewed enthusiasm around the GLP-1 space, which we'll talk about with Lilly, interest into the cancer meeting coming up in early June. And I think folks are, feeling better about things with regard to, say, the FDA now that Makary and Vinay Prasad, who were kind of controversial, are out of their roles.
Do you think the sector is still in kind of a innovation-led cycle?
I think so, for sure. We've seen a lot of M&A, so big biopharma scooping up the small, innovative biotech companies. And that's really a sign of a healthy innovation cycle where the small biotech companies doing the cutting edge science, generating clinical data that interests the big guys take them over and then bring them through to commercialization. So we're seeing that nice bit of M&A, which means we have some health in the sector.
Okay, so let's get into it then. You teased the first one already. Eli Lilly, you say back like they never left. Why is that?
Well, so heading into 1Q results, there was a lot of nervousness around guidance, around kind of the competitive dynamics with Novo Nordisk. And we were really looking to see what their oral GLP-1 pill, Foundayo, was going to do. I think that they put a lot of those concerns to bed. And what's really interesting today, we looked at script numbers for Foundayo versus the Wegovy pill. The Wegovy pill declined slightly, whereas we saw really nice growth for Foundayo. So we expect that to continue. When we look at Lilly, they don't just have an obesity metabolic franchise. They have neuroscience, oncology, immunology. And I think that over the course of the year, we're going to get more data for a key drug called retatrutide. A lot of folks are really interested in that. It could be an even better weight loss drug than, say, Zepbound. And of course, we'll see the pull through from Foundayo as they lean into DTC advertising to kind of drum up some interest with that asset.
You say it's important right now to remember not to over-index on. Right. Tell us more about that.
So, I think a lot of folks are really looking at the script numbers every week for Foundayo and the Wegovy pill, trying to figure out long-term trends. And we Lilly only launched Foundayo or Orforglipron in early April. It's mid-May. You can't really make long-term trends and predictions based off of, let's say, 6 weeks worth of data. I am encouraged with what I see. So I don't want folks to say, Novo's the winner, Lilly's the loser, or vice versa. You have to take it week by week, see what happens, and really look at the whole picture versus just one asset.
Okay, we'll move on to the next one now. Gilead Sciences, you've got an outperform rating on this one. Why is that?
Most definitely. So what's really interesting with Gilead is over the past 5 years, which was really remarkable, they have taken a lot of unnecessary OpEx out of their P&L. So now they are in a position where they can grow earnings while they invest in the business. For a long time, this company had been a laggard when it came to the multiple, right? They would always trade at a single-digit multiple, could never really get out of this value trap status. And now they've cleaned up the P&L. They are executing well with their long-acting prevention drug, Yeztugo. They've done some interesting acquisitions, and we're seeing consistent earnings growth, which allows for, multiple expansion. Folks are really comfortable with the story. We know that they have good revenue visibility into the 2030s, and now that they can invest, they can add more franchises to their already strong HIV business.
Okay, last up is Scholar Rock.
Sure.
Tell us more about this company.
So a little mid-cap biotech. What's really interesting about this is they have a drug for muscle wasting, but it's associated with a rare disease called SMA. Well characterized. Biogen has a drug for it. So we know where these patients are. The big controversy has been them getting this drug approved, not because it doesn't work, but because they've had issues with manufacturing, actually related to a facility owned by Catalent, now Novo Nordisk. So the TLDR with that is they are likely to get approved by September. They have a second manufacturing facility up and running and waiting for inspection by the FDA. Once that gets approved, I think people will breathe a sigh of relief. They're also well capitalized, so we're not worried about dilution near term. And I think this could fit nicely within, any big biopharma that either has an obesity or rare disease franchise, and there's many of those.
Just lastly, like you mentioned, the sector
Sure.
does have some areas to work on still. What's the main one, do you think?
A great question. I think that a lot of some of the larger names like a Merck, like a Bristol, and even an AbbVie, they still need to do some more BD to add to their pipeline. When you look at Merck, for example, we have a huge loss of exclusivity event at some time, in the late 20s, early 2030s, with Keytruda going off patent. So they're going to have to come up with $20 billion in new revenue. That's not easy to do. You got to do it with acquisitions, internal development. They're well on their way. They're not there yet, similarly with Bristol. And, you even look at AbbVie or Pfizer, right? These companies need to come up with, cohesive revenue stories end of the decade into the 2030s for folks to continue their comfort and continue investing for the long term.
That does it for the close. Thanks for joining us. Have a good long weekend.